As of the closing bell on Friday, November 28th, Beyond Meat Inc. is trading below the psychological $1 barrier, sitting at exactly 98 cents. We are looking at an intraday decline of roughly 3.8 cents, which translates to a 3.75% drop. If you are staring at your screen hoping for a miraculous recovery in the after-hour session, the data is not offering much comfort. The stock has slipped further to 97 cents, shedding another 1% in thin trading volume. This puts the stock firmly in penny stock territory, a place where volatility is king and fundamental investing often goes to die. When you see a once-celebrated unicorn like this trading for literal pocket change, the temptation to bottom fish is overwhelming. You look at the chart, you see the all-time highs of $200, and your brain does a quick, dangerous calculation. If it just goes back to $10, I make 10 times my money. That is the expectation. That is the trap. The expectation is that this is a beaten-down brand name that is simply going through a rough patch and is currently on a fire sale. The reality, however, is that we are looking at a company that is fundamentally restructuring its entire existence at the expense of its common shareholders. The drop to 98 cents isn't just a market fluctuation, it is a repricing of survival risk. We are witnessing the calm before a potential reverse stock split storm, a mechanism that often wipes out the equity of retail traders who are holding on for dear life. Today's price action is not about selling burgers, it is about financial engineering and the brutal mathematics of dilution. Let's look at the intraday mechanics we saw today because they tell a very specific story about who is in control. The selling pressure was consistent from the open. In a healthy stock, you often see a morning dip followed by buyers stepping in, institutions like Fidelity Wealth Management or smart money allocators using Schwab Intelligent Portfolios to pick up shares at a discount. We saw none of that today. Instead, we saw a steady stream of distribution. This suggests that whoever is selling isn't waiting for a better price. They just want out. They are hitting the bid, accepting whatever liquidity is available to exit the position. This is characteristic of capitulation, where longtime holders finally throw in the towel, or worse, where forced selling from margin calls is taking place. When you are engaged in online investing, especially with a platform like the Robinhood app or SoFi Invest, it is easy to get seduced by the low nominal share price. You can buy 1,000 shares for less than $1,000. It feels significant. It feels like you own a massive stake. But you have to understand the concept of market cap versus enterprise value. While the market cap has shrunk to under $500 million, the enterprise value is still propped up by a mountain of debt. Although the company recently announced a restructuring to reduce this debt load, the cost of that restructuring is dilution. They are effectively printing new shares to pay off old lenders. This means your slice of the pie is getting smaller and smaller, even if the company survives. I want to challenge the common belief that plant-based meat is the future and therefore this stock must recover. The contrarian take here, and the one that the market is violently agreeing with right now, is that Beyond Meat is not a technology company like Tesla stock or Apple stock. It is a food processing company with negative gross margins in a highly competitive, commoditized market. A tech company can scale infinitely with low costs. A burger company has to buy peas, process them, ship them in refrigerated trucks, and pay for shelf space. When inflation hit in 2024 and stayed sticky through 2025, the cost of all those inputs skyrocketed. At the same time, consumers, your average shopper at Kroger or Walmart, stopped paying premium prices for fake meat. They went back to real beef or cheaper proteins like chicken. This pincer movement of rising costs and falling demand is what crushed the stock, not some temporary market glitch. The volume we saw today was relatively high relative to the price, which is another warning sign. High volume on a down day usually means churn. It means shares are moving from frustrated holders to high-frequency traders and algorithms that are scalping fractions of a cent. If you are using interactive brokers trading tools, you probably saw the level 2 data flashing with massive sell walls at 99 cents and $1. The market makers are effectively saying, we will not let this stock cross back above $1 easily. Why? because the $1 mark is critical for Nasdaq listing compliance. This brings us to the most immediate and dangerous catalyst, the reverse stock split. On November 19th, shareholders approved a proposal to allow the board to enact a reverse split. This is often marketed as a way to regain compliance and attract institutional investors. The expectation is that if the stock price is higher, say $10 after a 1-to-10 split, it looks more respectable. The reality is that reverse splits are almost historically a death knell for current equity holders. It doesn't change the value of the company, it just changes the number of shares. But psychologically, it signals weakness. And historically, stocks that reverse split tend to sell off hard immediately after the split as the short restrictions are lifted and the artificial floor is removed. If you are holding shares at 98 cents thinking you are getting a deal, you need to be terrified of waking up to a reverse split announcement on a Monday morning. Let's dig deeper into the financials because the Q3 2025 earnings report released earlier this month was a sobering reality check. The company reported net revenues of $70.7 million. This beat expectations slightly, which is why you might have seen a brief pop in early November. But dig deeper. That revenue is down over 13% year over year. A growth company that is shrinking by double digits is not a growth company. It is a distressed asset. The U.S. retail channel, their bread and butter, was down over 18%. That is a massive collapse in demand. It means fewer people are buying the burgers at the grocery store. It means the novelty has worn off and the core customer base is shrinking. Even more concerning is the gross margin. It came in at 10.3%. For comparison, a healthy food company usually has gross margins in the 30 to 40% range. Tesla stock has higher margins on cars than Beyond Meat has on pea protein patties. A 10% margin leaves almost no room to pay for marketing, R&D, and administrative costs, which is why the bottom line is so ugly. They posted a net loss of over $110 million for the quarter. They lost more money than they brought in as revenue. Let that sink in. For every dollar of burgers they sold, they lost roughly $1.50. This is not a sustainable business model. It is a cash incinerator. We also need to talk about the IV product line. The expectation was that the new BYND IV version, with avocado oil and better nutritionals, would win back health-conscious consumers. The reality is that the sales data doesn't show a resurgence. The health halo of plant-based meat has been shattered by a counter-narrative that highlights the heavy processing and long ingredient lists. Whether that narrative is fair or not doesn't matter. The market trades on perception. If the consumer perceives the product as processed goop rather than healthy plant protein, the brand equity evaporates. We are seeing this play out in real time with the revenue declines. I want to pause here and ask you a question, because I know many of you have tried the product. Comment below if you are still buying Beyond Meat products regularly, or if you tried them once and moved on. Do you think the taste has improved, or is it just too expensive? I'm really curious to see if the Main Street view matches this brutal Wall Street valuation. Let's discuss the institutional landscape. When you look at Fidelity ETFs or Vanguard funds, you are seeing them reduce exposure to this sector. They are rotating into quality and profitability. Beyond Meat offers neither right now. The institutional ownership that remains is likely passive. Funds that have to own it because it is in an index, or distressed debt investors who are playing the bankruptcy or restructuring angle. This is a very different game than buying Nvidia stock for growth. You're swimming with sharks that specialize in picking the meat off the bones of distressed companies. The recent debt restructuring is a critical piece of the puzzle that often gets misunderstood by retail investors using Robinhood crypto or stock accounts. The headline said they reduced debt. That sounds good, but they did it by exchanging debt to equity or convertible notes. This dilutes you, the common shareholder. The new notes due in 2030 have a conversion price of around $1.75. This effectively puts a lid on the stock price. If the stock rallies to $2, those bondholders will likely convert their debt to stock and sell, flooding the market with supply. This creates a massive structural resistance level that is very hard to break through. It's like trying to run up a hill while someone is throwing boulders down at you. Let's look at the macro environment again. We're in a world where real assets are king. People want gold, land, oil, and profitable companies that pay dividends. Think of the companies you find in Fidelity mutual funds. Speculative, loss-making growth stocks are out of fashion unless they have an AI angle. Beyond Meat is the opposite of AI. It is tangible, perishable, low-margin inventory. In a high-interest rate world, the opportunity cost of holding BYND is huge. You could be getting 5% risk-free in a money market fund. Why risk your capital on a stock that drops 4% on a random Friday? The short squeeze thesis is the last refuge of the bull. Yes, the short interest is high, around 40% of the float. This is incredibly crowded. The expectation is that if good news hits,